Okay, so let's continue from where we left. Let's continue from where we left. We want to continue from where we left. That means today we want to start a new topic. Today we want to start a new topic, and that is the topic called financial instruments. That's the topic called financial instruments. So let me introduce it. Let me introduce it first. Okay. Now, as a company, there are many ways in which you, as a company, you can borrow finances to finance your business. One way of financing your company is that you can decide to issue ordinary shares. You can decide to issue debentures, or you can decide to issue preference shares. These are just different ways of raising finances. Now listen. So we want to assume you are a company A that wants to raise the finances. So it means that another person or another company, let's call it company B or person B, will be the one to give you the finances. For example, he might decide to buy your shares, he might decide to buy your debentures, or he might decide to buy your preference shares. So you, as company A, who is trying to borrow finances, we normally refer to you as the borrower. B, who will buy these instruments, we refer to them as the lender or the investor. So company B or person B will be the one investing in A by buying their shares or buying their debentures or buying their preference shares or buying their preference shares. Now, to you, B Limited, let's call you B. Whether you are buying shares, whether you are buying debentures, whether you are buying preference shares, you are investing. So in your books, you as B, all these instruments will create what we call a financial asset to you. It's an investment. So we are saying, in other words, all these instruments to the lenders, they would create a financial asset, or in other words, an investment. To B, not to A, who is borrowing the finances, click on the video again. Click on the video again. Click on the link. Okay, somebody saying it can't play. Let me say this. Listen now. Listen. Somebody says it can't play. Now listen. Somebody to chat to tell him to click on the link down there. Click on the link. Amesema it is not. The video is not playing. Let him not click on the upper part. Let him click on the link down there. So listen. Let me now explain to everybody. Now. I take this opportunity now. Listen, because it's a new class. Sorry. Yes, Mwambia, click on the link down there. Not on top, not on the video, on the link. Not on the video, on the link. Yes, not on the upper part, on the link down there. Okay, now let me take this opportunity now also to say this. Listen, let me also take this opportunity to say this before we continue. There are times when, listen, you will be or you may be disconnected because of your Wi-Fi strength being weak. Listen, I'm saying especially to the new students, because again, today is a free class. Listen carefully. There are times when you may be disconnected because of your Wi-Fi strength being weak. If you are disconnected and you try, listen, and you try to click on the disconnected video and it doesn't bring you back to class, then listen, then we are saying there are two other ways of rejoining the class. One way is to refresh the page on which you are watching the video. Normally, on the top left or on the top right of your page from which you are watching this video from, normally there is a refresh button and it looks something like this if your gadget has it. So in case you are disconnected, you can click on that refresh button to refresh your page. That will bring you back to class. In case, now listen, in case your gadget does not have the refresh button, either on the top left or top right, then you go back to the group where the link was posted and you click on the link again. Sometimes you may click on the disconnected video and it doesn't take you back to class. So I've said two ways. You either refresh the page using the refresh button, or you go back and click on the link that you received again. That will make you come back to class again. Okay? So I hope you have understood. So that is only for the new students, because our old students are already aware of the mechanisms of how, especially live classes. For recorded videos, normally that does not have issues. But for live classes, sometimes you may be disconnected. Connect back, refresh the page, or you go back and click on the link again. That will only happen if the clicking of the video does not take you back to class. Good. And so now listen, before I even now continue, because of that opportunity that has arisen, let me ask you, please subscribe to my YouTube channel, so that in case we post more videos in the YouTube, you will be able to watch them as we post them. So for those who have not subscribed, there is a subscription button down there. You can even click it as we are watching now. As you are watching now, click that subscription button, and then you also can click the notification bell. So that is it. So I've talked about how to rejoin the class in case you are disconnected. You refresh the page, or you click on the link that was sent. That is if by clicking the disconnected video, it doesn't bring you back to class. Most times it doesn't bring you back to class. So Abdi, I think, was having that problem. He was clicking on the video up there that was sent. It looks like a video, but it's not a video. You click on the link down there. That is Abdi. We are talking to Abdi. I hope he has been assisted now. That's what we are saying. Okay. Then I've taken that opportunity to explain how to come back to class in case you are disconnected. And I've appealed to those who have not subscribed to my YouTube channel. Please subscribe. Just now, as you are watching, you can even subscribe by clicking the subscription button. So let's continue from where we left. I hope now we are all together. I hope we are all together now. So let me now continue with what we were discussing about financial instruments. Okay. Joel Modoni says what? Good. You are saying you are loving the class. Good, thank you. So let's continue. So I was saying this. As a company A, you want to borrow finances. I told you, you can either issue ordinary shares, or you can issue debentures, or you can issue preference shares. I told you, somebody somewhere or a company somewhere will have to buy these instruments. That person, we were assuming him to be B, we were saying that B, we normally refer to them as the lender or the investor. I've said, when B buys your shares, when B buys your debentures, when B buys your preference shares, in their books, who B, they would have an investment account. For example, if they buy shares of A, they will have an account called investment in shares of A as an investment. If they buy your debentures, they would have an account called investments in debentures of A. If they buy your preference shares, they would have an account called investment in preference shares of A. So to B, all these instruments will create what I've called a financial asset. They will create a financial asset. What about to the borrower? A. Listen, if they, let me even change this and make it a bond. If the investor buys your debentures and your bonds, if the investor buys your debentures and your bonds, to you, A, that will create what we call a financial liability. It will create what we call a financial liability. Why? Because you have an obligation to pay them back. These debentures, you have an obligation to pay back. These bonds, you have an obligation to pay back. Listen. And if B buys your ordinary shares, then to you, A, that will create what we call equity capital. That will create what we call equity capital. Now listen. So what is a financial instrument? We normally say, or we normally define a financial instrument as a contract. It is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. A financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. To the borrower, a financial instrument would create equity capital or financial liability. And to the borrower, and to the investor or to the lender, it creates what we are calling a financial asset. Good. So let's put down that introduction in terms of notes now. Let's put down that introduction in terms of notes. So let's put down the subhead at the topic. The topic is financial instrument. Then you say this. Then you say this. A financial instrument is a contract. Put it down. A financial instrument is a contract that leads to a financial instrument is a contract that leads to a financial asset to one party. It's a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. Then you say this, another paragraph. To the borrower, a financial instrument creates To the borrower, a financial instrument creates either equity capital or financial liability. I've said, to the borrower, a financial instrument creates equity capital or a financial liability. Continue. And to the investors, it creates a financial asset. And to the investors, it creates a financial asset. It creates a financial asset. Good. So let me now continue from there. We have introduced what our financial instruments are. Okay, now listen. We want to talk about now, how do you recognize what we call recognition? Don't write. Recognition and measurement. Recognition and measurement of financial instruments. Recognition and measurement of financial instruments. That's what we want to discuss. Now, whether it is to the borrower or to the lenders, listen, to any of these two parties, the moment they were signing that contract, all of them are required to recognize that financial instrument at its fair value. At its fair value. Let's assume that you, company A, you issued some ordinary shares, and B bought 10,000 shares. B bought 10,000 shares at a market price of 50 shillings. So what is the fair value at that date? So B, in their books, they will have an account called investment in shares of B at how much? At 50 shillings. No, in shares of A. They will have here bank, that is 10,000 times 50, that's 500,000. So B will recognize that at its fair value. So all financial instruments, whether it's a financial liability, whether it's a financial asset, to the borrower and to the investors, all financial instruments should be recognized at their fair values. That is on initial recognition. This is on initial recognition. Now, listen. What about at the end of the year? How will you recognize this instrument? You have bought Safaricom shares at 500,000. That's a market value. At the end of the year, how do you recognize what is the value you will carry down by the end of the year? That's what I want to talk about now. So on initial recognition, all financial instruments should be recognized at their fair values. Subsequent measurement now depends on the classification of the financial instrument. In other words, is it a financial asset? It depends now. Subsequent measurement depends on the classification of the financial instrument. In other words, is it a financial asset or is it a financial liability? That's what we are saying. How you remeasure them in the subsequent periods depends on the classification of the financial instrument. Now listen, if you are dealing with a financial asset, then that financial asset, whichever it is, it can be remeasured in any one of the following three ways. For a financial asset, it can be remeasured at the end of the year in any one of the following ways. One, it can be measured at what we call at amortized cost. That's one way. The second way it can be remeasured is at fair value, through OCI. We call it through other comprehensive incomes. I'll talk about it in a short while. That's another way, that there are some assets that can be measured at fair value through OCI. Then we have others which can be measured at fair value through P&L, through profit and loss. So we want to ask ourselves, what kind of financial assets are these that should be remeasured by the end of the year at amortized cost? Which are these financial assets that should be measured at the end of the year at fair value through other comprehensive income, that is OCI? Which are these financial assets that should be measured at fair value through P&L? Those are the ones I want to talk about now. So let me introduce that area now. How to recognize financial assets. So we are discussing still, I've not talked about financial liabilities. I'm discussing about financial assets. I've told you, for financial assets, they can be recognized in any one of the following three ways. One way I've told you is that they can be remeasured. At the end of the year, they can be remeasured at amortized cost. Two, I've said there are others which can be remeasured at fair value through OCI. Then I've said there are others that can be measured at fair value, through P&L. Good. Now, listen to this now. Which are these assets? In other words, what characteristics should that asset have for it to be measured at fair value? What features must it have for it to be measured at fair value through OCI, at fair value through P&L, or at amortized cost? That's what I want to talk about. For the amortized cost, let me go back here. Company A, listen, Company A issued 10% bonds whose nominal value was 200 million. Or maybe they issued a 10% debenture whose nominal value is 100 million. If, as an investor, you bought these bonds, it is obvious from your finance knowledge, you know that if I bought a 10% bond whose nominal value is 200 million, 10% bond whose nominal value is 200 million, then me as an investor, I am guaranteed a fixed return every year. 10% of the value of that bond is what I'll be receiving every year, which is how much? 20 million. Which is 10% of 200 million. Then in the year of redemption, in the year the bond will mature, as an investor, I'll be given back my principal. So I've already mentioned two characteristics there, that this bond is one that assures me of a fixed return. 200 million times 10%, that's 10 million. Two, in the year of maturity, I'll be paid my 200 million principal. Now, if as an investor, listen, if as an investor you have bought a financial instrument which has the following, listen, which has the following characteristics, then it should be measured at its amortized cost. 1, if you bought a financial asset with the aim, listen, with the aim of collecting, you are holding, or we can say you are holding an investment, that means it is held, it's a kind of an investment you are buying, which is held to maturity, to collect. You are an investor holding this investment to maturity to collect what we call contractual cash flows. To collect what we call contractual cash flows. I've already told you which are these cash flows. The interest, 20 million every year, and your principal in the year of maturity. So if you are holding a financial instrument to maturity with the aim of collecting those contractual cash flows, that's one characteristic. 2, the cash flows are for payment of interest and principal. They are for payment of interest and principal. So if you have an investment which meets those two characteristics, then we are saying that investment by the end of the year should be measured at its amortized cost. We shall talk about how to calculate the amortized cost, but just know that when you're asked what are these kind of financial assets that should be classified at amortized cost, they are those investments which are held to maturity with an aim of collecting contractual. Contractual means they are obvious, to collect contractual cash flows. Number 2, I've said the cash flows are for payment of interest and principal. Good. That is it. We now move to the second category, that is those to be measured at fair value through OCI or through other comprehensive income. Listen, I started by saying all financial instruments should initially be measured at their fair values. Then come the end of the year, here is another investment which will also be remeasured again at the end of the year at fair value. Listen, but whatever is the change in fair value, that change is the one now we are saying take it to other comprehensive incomes. We have already done published accounts, and so you know where you normally take what we call other comprehensive incomes. You remember we have already done published accounts. Good. So whatever is the change, it could be a gain or it could be a loss. But the rule says take it, that change, take it to the section called other comprehensive incomes. If you look at the last box, at fair value through P&L, there are those investments again which you measured at fair value initially, and again at the end of the year you still measure them again at fair value, but the change in fair value now goes through profit and loss. Now goes through profit and loss. So we shall see what are these. So for the last one, whatever is the gain or loss, you take it to the profit and loss. For the second one, whatever is the gain or loss of the change in fair value, take it through other comprehensive incomes. Good. Now, Under this second category, we have two subcategories. Under this second category, we have two subcategories. One is for what we call debt instrument. And the second category is for what we call equity instrument. Now, you as an investor, if you bought a debenture or if you bought a bond, you will be repaid the amount. So you are buying a debt instrument. If you buy your shares of company A, if you buy the shares of company A, you are buying what we call an equity instrument. You are buying what we call an equity instrument. So under this subcategory of at fair value through OCI, we have two subcategories. Let's start with those which are of debt in nature, like a 10% bond or a 10% debenture. Now, for it to be classified or to be remeasured, listen, for it to be remeasured at fair value through OCI, then again it has to meet the following two conditions. Let us assume it's a 10% bond. So one, it must be again that investment it's held to collect contractual cash flows. You're aiming or you are holding it to collect contractual cash flows. Listen carefully now. Listen carefully here. And to sell before maturity. And to sell before maturity. The first one, which is at amortized cost, you bought it with an intention of holding it until maturity. Are you there? But for this second one, which we are saying at fair value through OCI, yes, it's a 10% bond. For example, listen, there are many companies that raise finances by issuing bonds in the stock market. You as an investor, you went to the stock market and you bought a 10% bond. It will mature in 10 years. But your aim as an investor is to wait. The moment the price of the bond goes up in the stock market, you sell and make a profit. You don't aim to keep it until it matures. No. So for that kind of an investment, it is the one we are saying it should be remeasured at fair value, and the change in fair value should now be taken through other comprehensive incomes. So one of the characteristics for a debt instrument is one that is held to collect contractual cash flows, and to sell. This is to sell before maturity. Number two, under that still, cash flows are for payment of interest and principal. So the cash flows you are receiving are still for payment of interest. If it happens that by the time the bond matures you have not sold, you will still receive back your principal. So I hope you have managed to get the difference between the ones at amortized cost and the ones at fair value through OCI, and especially for debt instrument. Good. That is one. It's held to collect contractual cash flows and to sell before maturity. That's your aim. But these cash flows I'm receiving, are for payment. They are always in form of payment of principal and interest. These cash flows are for payment of interest. Cash flows, these are what cash flows. Cash flows are for payment of interest and principal. Good. That is it. What about you bought some shares? If you bought shares, then we say they are classified as equity instruments. What should the characteristic of these shares have? What characteristics should they have for them to be remeasured again at fair value through OCI? Listen, if you bought shares, then you are having equity instrument. Now listen, if you bought them with an intention of keeping the shares for long term, not for speculation, went to the stock market, bought the shares, and your aim as an investor is to keep them for long term, then such kind of shares, you remeasure them at fair value, and the change in fair value goes through OCI. So here we can say it is for shares held for long term. That is, i.e., not for trading. You are not using them for trading. That means for speculation. No. You are not holding them for speculation. You are holding them for long term. Good. That is another category of a financial asset. Once we have said, should be measured at fair value through OCI. Finally, we have the last category of financial assets that should be measured at fair value through P&L. What kind of financial assets are these? Listen, these are any other financial assets. Any other financial asset, which of course, if you have another financial asset that cannot be measured at amortized cost, you have a financial asset as an investor that cannot be measured under fair value through OCI, then that kind of a financial asset should still be measured at fair value, and the change in fair value, now take it through P&L. Now you take it through P&L. I hope you can think of an example of an investment that you have as an investor, which cannot be classified under the first category at amortized. It cannot be classified under the second category at fair value through OCI. Now it is the only place remaining. Other investments now will be measured at fair value through P&L account. Listen, for example, if you bought these shares from Safaricom or whichever company, and you are buying them with the hope that the market price will increase so that you sell, then you can't put it under this. Yes, they are shares, but under that category we have called equity instrument. It is those which were held not for trading, but for long term. Okay? You can't put them under amortized cost, those shares. Why? Because they are not guaranteeing you of a fixed return in terms of interest and principal. No. So we are saying, therefore, the only other place you can put that asset is at fair value through OCI. So we can even say here, we can even put down here, we say e.g. shares for trading. Shares for trading. That's what we are saying. Good. I think I'm through now with the how to recognize financial assets. Maybe we can now put down the subheading. Let's put down the subheading. Andika subheading. Recognition and measurement. Recognition and measurement. Recognition and measurement of financial instruments. As a subheading, recognition and measurement of financial instruments. Then you say this: all financial instruments should initially be measured. All financial instruments should initially be measured at their fair values. All financial instruments should initially be measured at their fair values. Another paragraph. Subsequent measurement depends. Subsequent measurement depends on the classification. Subsequent measurement depends on the classification of the financial instrument. Subsequent measurement depends on the classification of the financial instrument, i.e. whether the financial instrument is a financial asset or a financial liability. Whether it's a financial asset or a financial liability. Then you say this: the following are the three ways in which financial assets should be remeasured, should subsequently be remeasured. The following are the three ways in which financial asset should subsequently be remeasured. So some questions will ask you the categories of financial assets. Some will ask you to state how they are remeasured. So the following are the three ways in which financial assets are subsequently remeasured. One at amortized cost. Two at fair value through OCI. Somebody is saying he's watching from Garissa. Somebody else is saying he's watching from Naivasha. Thank you. Welcome. I hope you are getting. Abdi, I hope you are understanding. The one watching from Naivasha, Salome. So number one, I've said at amortized cost. Two, at fair value through other comprehensive income. Put it in full. At fair value through other comprehensive income. Then you put in bracket OCI. Number two, at fair value through other comprehensive income. Then you say in bracket OCI. 3, at fair value through profit and loss. That's number 3, at fair value through profit and loss. At fair value through profit and loss. At fair value through profit and loss. Then, now listen everybody now. I don't have to write the summary of what we have already said about the characteristics. This chart is enough to explain the characteristics. So maybe you can copy this chart now. You can now copy this chart. Copy that chart. First you have the top, financial asset. Then I've said we classify them into 3. Either it's a financial asset at amortized cost, at fair value through OCI, and at fair value through P&L. So have those 3 branches. Have those three branches. Then once you have the three branches, we have said now we have looked at the characteristic of each of those three branches. So the first one is at amortized cost. And you can put down, maybe you can even write here, listen. Just to remind you, listen carefully now. You can put their conditions. I did not mention that, but I gave you the conditions. Conditions for it to be measured at amortized cost. Those are conditions. 1, held to maturity to collect contractual cash flows. 1, you are writing the one at amortized cost. Then you say this. Number 1, held to maturity to collect contractual cash flows. And number 2, still under that. Number 2, still under that, you say cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. So that gives you those. Umemaliza. So number 1, held to maturity to collect contractual cash flows. Number 2, cash flows are for payment of interest and principal. Good. Once you are through with that, we go to the second category now. That is at fair value through OCI. And I've told you, under that we have 2 subcategories. We have that which is in form of debt instrument, and the one which is in form of equity instrument. So have that subdivision of that second category. Have that subdivision of the second category. That is debt instrument. And the second branch of that subcategory is equity instrument. Then when you come to the second or for debt instrument, you can even put their conditions. Just to remind you, what are the conditions for an instrument to be classified at fair value through OCI? And it's one of debt in nature, the debt instrument. What are the conditions? 1, held to collect. Number 1, held to collect contractual cash flows. Held to collect contractual cash flows and to sell before maturity. That's important. And to sell before maturity. And to sell before maturity. That is your aim as an investor, to sell before maturity. Then number 2 down there, you come and say cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Okay? Good. So finish. We want to go to the second branch of that second subcategory. That's what we are calling equity instrument. Equity instrument. If you are through, you can say for shares held. This is this is for shares held. Shares held for shares held for long term, i.e. not for trading. Not for trading. For shares held for long term, i.e. not for trading. That's the condition. It's only one condition. Then finally, I want to roll up again. The last one was at fair value through P&L. The last box was at fair value through P&L. That one I've told you for any other financial asset. For any other financial asset, e.g. shares for trading. E.g. shares for trading. E.g. shares for trading. E.g. shares for trading. To finish, e.g. shares for trading. Okay. I hope you are through with the copying now. If you are through, somebody can say done so that I know we are through. Mtu aseme to chat, you say done so that I know you are through, so that we now develop the topic. Whoever is done, you can chat there and say done. Oh, good. Thank you. Sawa. So now we are through. Let me go on. Let me go on now. I hope the others are through also. I hope the others are through. Thank you. At least majority now are through. Good. Now listen. I want to take you back now here. I want to take you back. Listen. Watching from Baringo. Thank you. Enoch, watching from Baringo. I hope you're understanding. I hope you're understanding. Now, let me take you back. When I started, I said, all financial instruments, listen to this now, all financial instruments, I told you, should be measured at what? At fair values. Then I told you, listen, subsequent measurement depends on the classification. That is it a financial asset or is it a financial liability? Listen, for the financial asset, I am through. Now I want to talk about financial liability. How are they measured? If you have a financial liability, how is it measured? Remeasured. Because initially, again, it was measured at fair value. But in the subsequent period, how is it remeasured? And I want to assume that the financial liability I'm dealing with here is the 10% bond, whose nominal value is 200 million, or the debenture, whichever it is. That's the financial liability. Now, at the end of the year, this financial liability should be remeasured at its amortized cost. The financial liability should be remeasured at its amortized cost. Listen, you as the borrower, we are now talking from the point of view of the borrower. Listen, when we were discussing financial asset, we were talking in terms of view from the lender, the investor, because for the borrower, he cannot have a financial asset. I said it's either equity or financial liability. Now we are looking at this from the point of view of the lender. No, the borrower now. It is creating a financial liability to him. That financial liability, I've said, by the end of the year, it should be remeasured at its amortized cost. You as the lender, the borrower, you issued a 10% bond. Initially, you measure it at fair value. We shall talk about how to compute it. In the subsequent period, you measure your financial liability at its amortized cost. Now, if I'm giving a condition now, if as a lender, you issued this bond maybe through the stock market. Listen, you issued it through the stock market with the aim of waiting to see the moment the price of the bond goes down, you redeem the bond, you buy back the bond. Remember, the guys gave you 200 million. Now the price on the market is 180. If as a borrower, my aim was to issue this bond, and when the price goes down, I redeem it. So meaning I'll pay 180. I got 200 initially. Now I'm paying 180. I've gained. Of course, listen, not many companies issue bonds for speculation. No, most of them issue the bonds or debentures to raise finances, which are to finance the business. So in most cases, those financial liabilities should be measured at amortized cost. Because your aim is to redeem them in the year of maturity. You are not issuing them so that you redeem them when you make a gain by the price going down. No. But in case there's a company which is holding them with the motive of paying them back when the price goes down, that means for speculation, listen, then that financial liability, by the end of the year, that kind of a financial liability, by the end of the year, it should be measured again at its fair value, and the change in fair value, you take it through P&L. Meaning, if it's a financial liability for speculation or for trading, then it should be remeasured at fair value through P&L. You measured it initially at fair value. In the subsequent period, you ask yourself, am I holding this bond until maturity? Yes. Then measure it at its amortized cost. Am I holding this bond with the aim of paying when the price goes down? Then measure it at fair value through P&L. I've said it is rare for a company to issue bonds with an aim of selling them or redeeming them when the price goes down. That means for speculation. But in case, that's what we're saying. So maybe somewhere after you're through with this table, andika something like this, NB, NB, NB. You say this, financial liabilities should be remeasured at their amortized cost. Should be remeasured at their amortized cost. Unless they are for trading. Unless they are for trading, in which case, they should be remeasured. Unless they are for trading, in which case, they should be remeasured at fair value through P&L. In which case, they should be remeasured at fair value through P&L. Good. So I've discussed now how to remeasure them, both the financial asset and the financial liabilities. Good. Now let's proceed. I want to start with a scenario of a financial liability. In other words, I want us to discuss how do we determine a financial, the figure called fair value. We are discussing now financial liabilities. Don't write. We are discussing now how to deal with financial liabilities. We shall talk about financial assets later. But let us now look at how do we measure the fair value initially? How do we measure the amortized cost at the end of the year? I've told you all financial instruments, initially they are measured at fair value. So if it's a financial liability, how do you measure its fair value? And then subsequently, how do you determine its amortized cost? So let me develop an illustration just to come up with the fair value and the amortized cost. Good. Now listen. A company A issued a 10% bond whose nominal value is 200 million. This bond will be redeemed after 5 years. The question will tell you whether it will be redeemed at par or maybe at a premium. When they say at par, then if it has a nominal value of 200 million, then you will pay it back at 200 million. There are some companies that want to incite investors so that they invest. So they tell them, you give me 200, but when I'm going to redeem this bond, I'll pay you at 5% premium. 5% of 200 is an extra 10 million. So in the year of redemption, you will be paid 210 also. So in such a case, the company said to redeem the bond at a premium. So but for now, let us assume, for purpose of illustration, that this bond will be redeemed in the 5th year, whatever it is. Now listen. Every year, you as an investor, as a borrower, you will be paying the investors 20 million, 20 million, 20 million every year. Now, to raise this money, listen to this now, to raise this money, it may happen that you decided that you are going to issue it at a discount of maybe 5%. You wanted customers the people to buy your debentures. So instead of giving them to buy at 200, you told them, in the year I'm going to redeem in the 5th year, I'm going to pay you 200, but you buy it now at a discount of 5%. So you decided to issue it at a discount. So it means, did you receive as a company 200 million? No. The nominal value is 200. Fine. If you issued it at par, then you receive 200. But if the question tells you you issued it at a discount, you come and say a less discount. 5% of that, let me use 2.5%. What's 2.5% of 2.5% of 5% is about 10 million. Okay, let's just keep it 5%. 5% of 200 million is 10 million. So that's a discount. So you will end up receiving 190 today. You issued a bond whose nominal value is 200 million. You are issuing it at a discount of 5%, which means you are going to receive 190. Listen. The question might tell you, in the process of trying to issue this bond, you had incurred what we call an issue cost, or what in finance you called a flotation cost. Maybe you had to hire accountants to prepare prospectus, a lawyer to draft the agreement with whatever, and so on. So in the process of trying to raise these finances, as company A, you incurred some issue cost. Let us assume that you incurred issue cost amounting to 5 million. So effectively, what did you receive from this bond? You did not receive 200 million. You received 185 million. That 185 million being the net proceeds from the issue of the bond, that 185 million is what we call the fair value. That is the net proceeds. So whatever are the net proceeds on the initial recognition, that net proceeds becomes the fair value. If maybe the question just told you we issued a 200 bond, and maybe we incurred an issue cost of 5 million, then that means you take 200, you minus an issue cost of 5. You received 195. We are introducing a concept of what if it was issued at a discount. To raise the money, you issued this bond whose nominal value is 200 million at a discount of 5%. So you gave a discount of 10 million. So effectively, we are concluding, if these two things happened, that is the discount and the issue cost, then effectively you received 185 million. That 185 million becomes the fair value on initial recognition. Now listen. Now we want to talk about, what about at the end of the year? How do you remeasure it? This same bond, I've said, you will now remeasure it at its amortized cost. To determine the amortized cost at the end of the year, you prepare the amortization schedule, where you will have a column for the year, you will have a column for the balance brought down, you will have a column for what we call finance cost. I'll talk about it. You will have a column called cash paid, and you will have a column called balance carried down. By the beginning of year 1, you have a liability of 185 million. That's the liability that you're beginning with. That's the fair value. Then, to compute the figure we are calling finance cost. In other words, listen, how much will you as company A charge in the income statement this year as the interest charge for the year? To get the interest charge for the year, you will now not use the 10%. It's true, you issued a 10% bond. Listen, I've also told you, every year you will be paying 10% of that 200 million, which is 20 million every year. That 10% is what we normally refer to in finance, we normally refer to it as the coupon rate. But to compute the finance cost or the interest charge for the year, we use an interest which is called the effective interest rate for the bond. The question will tell you, what is the effective interest of this bond? What is the effective interest of this bond? Let me assume for now that the question tells you that the effective interest of the bond was 12%. So we use the effective interest to compute the finance cost or the charge for the year. So you take 12% of that 185. For purpose of illustration, let me just assume 12% of 185 million. That will come to something like 22.2. Let me, for purpose of assumption, take it as 22. Now listen, the cash that we are paying, every year I've told you, as a borrower, you are paying 10% of 200 million. 10% of 200 million. Every year I told you are paying 20 million. So to calculate the cash paid, you use the coupon rate. And it is the coupon rate on the nominal, not on the balance brought down, on the nominal, which is 10% of 200 million, which is a constant amount every year, 20 million. So you began the year with a liability of 185 million. Then you are being charged 22 million as interest. But come the end of the year, you have only paid 20 million. So what are you carrying down by end of year one? You are carrying down 185 plus 22 minus 20. That is the same as taking 22 minus 20. That's a positive 2. Add to 185. It means I'm carrying down 187. 187. Then I bring it down by the beginning of year two. That 187 million. I charge again 12% of that. For purpose of illustration, let me assume it comes to 23 for purpose of illustration. Then again, you pay 20 million every year because the coupon rate is 10%, 10% of the nominal, 10% of the nominal. So this will give me a carry down of how much? 23 minus 20, that's positive 3, plus 187, that's 190. Okay. Then I bring it down by the beginning of the third year, that is 190. I ask myself, what is the effective interest rate? 12%. 12% of 190, for purpose of illustration, let me assume 24. Then you pay again 20 million in that year. Then you carry down a balance of how much? 24 minus 20, that's 4, plus 990, that's 194. Then you come to year 4, you start with 94, 194. For purpose of illustration, I'm assuming I take 25%. At 12%, I get 25 million. I pay 20. That means I'm carrying down 199. Then in the final year, listen, in the final year, I bring down the balance 199. I charge 12%. That will be assuming 26. Listen, you will still pay. Listen, you will still pay the premium or the interest, and at the same time, you will now redeem this bond. You will now redeem this bond. If the question told you that you are redeeming how did we get? The question will tell you, Joy, you are asking what? Let me get your question right. How we got the 12%? No, the question will tell you. I will say it, the question will tell you what is the effective. 12% is the effective interest rate. Effective interest rate. That one, the question will tell you. Are you there, Joel? Is it Joel or Mwendwa? Mwendwa, are you there? The question will tell you. They will tell you. Just like the question will tell you the company issued a 10% bond whose nominal value is 200 million. Okay, thank you. Where I said you may be told the effective interest rate is 12%. So the question will tell you. Good. But I've said the effective interest rate, we use it to compute what? The finance cost or the interest charge. The coupon rate we use to calculate what? This 20, listen carefully. This 20 that I'm paying, I am not paying the loan. I am only servicing the interest. The 20 has nothing to do with the 200 million. No. Don't forget, the bond will be redeemed in the 5th year. So when I'm paying 2020, listen, I am not paying part of the loan. I am only servicing the interest. So this 10%, we use it to calculate what we call the cash interest paid. The cash interest paid, not the effective interest, the cash interest paid. Good. So I was saying, in the 5th year, you have to go back to the question. You find out, how are we redeeming this bond? Are we redeeming it at par? If the question tells you are redeeming at par, then you pay another 200 million on redemption because you are redeeming. If, assuming the question tells you you are redeeming the bond at a premium, let us assume Now the question tells you at a premium of 2.5%. The nominal value was 200 million. If the question tells you are redeeming it at a premium of 2.5%, so on top of the 200 million, you will add another 2.5%. What is 2.5%? 5% of 200 million, we saw it's 10 million. Half of the 10 million is 5 million. Good. Meaning you are redeeming it at a premium of an extra 5 million. So there you will now come and pay 205 million. And once you pay, listen, once you pay, there should be no balance at all because you have redeemed the bond. You have redeemed that bond. Are you there? Good. So this is just, listen, this is just the amortization schedule. So these figures we are carrying down are what we are calling the amortized cost. What we are calling the amortized cost. Good. Now, but we have not asked ourselves, how will these figures affect P&L account and balance sheet? Because you may be told by the question, prepare profit and loss extracts for each year. You're also told, prepare balance sheet extracts for each year. For who? For the borrower. So if you are told to prepare profit and loss extracts, listen, an extract is a section of something. You will now need a column for the year, and you will now know the interest that goes to the P&L account, or you can even call it finance cost. That's what goes to the P&L account. Finance cost. Year 1, year 2, year 3, year 4, year 5. We have seen from the table, in year 1, I am charging 22. In year 2, how much was the interest? 23. Year 4, 24. Year 5, 25. Year 6, that was 26. That is how this instrument will affect P&L. What about in the balance sheet? This amortized cost will go to the balance sheet as a liability. Now listen. So if you are required to prepare balance sheet extracts, which you will need year 1, year 2, year 3, year 4, year 5, I want you to listen now. Among your non-current liabilities, you will have what we call the 10% bond. Somewhere along your current liabilities, you will also have what we call a 10% bond. I want you to listen now to the explanation now. Let's go back to our table. Look at that table. By end of year 1, I am carrying down a liability of 187 million. Listen, I have told you this bond will be redeemed in the 5th year. So though I am paying 20, I have told you that is only the interest I am servicing, not the loan. The loan will be repaid in the 5th year. Listen. So the argument is, if I have a liability of 187 by end of year 1, and that bond will be paid, or that amount will be paid in the 5th year, it means that by end of year 1, I still have how many more years to go before I pay this 187? I still have the 2nd year, 3rd year, 4th year, and the 5th year. I have 4 more years to go for me to pay that 187. So I'll take it in the balance sheet of year 1 as a long-term liability. That's what you'll do. A 10% bond of 187. That year, there will be no current liability. Okay? Then you go back to year 2. Year 2, we are carrying down a liability of 190. Everything of this 190 will be part of the 205 to be paid in the 5th year. So if this bond will be redeemed in the 5th year, then I ask myself, this 190, I still have how many more years to go? I still have the 3rd year, 4th year, and the 5th year. I still have 3 more years to go. So by end of year 2, I'll take that 190 as a long-term liability. So I take it to the balance sheet as a long-term liability. That one what? Sorry, I've forgotten 190. That's what I take to the balance sheet as a long-term liability. Good. Of course, in that year, there will be no current. 3rd year. By end of 3rd year, I'm carrying down a liability of 194. That will be redeemed in the 5th year. So how many more years do I have? I still have the 4th year and the 5th year to go. 2 more years to go. That means, again, it's more than a year. It's long term. How much? 194. Take it to the balance sheet of year 3 as long term. No current. Now watch year 4. Now watch year 4. By end of year 4, I'm carrying down a liability of 199. Listen, in the next 1 year, we are at the end of year 4. In the next 1 year, I will have already paid it. So it means, therefore, that by end of year 4, I still have only 1 more year to go for me to pay that 199. So that 199 taking me less than a year. Because it will take me less than a year to pay, then I take it to the balance sheet of year 4 as a current, not long term, as a current liability. So in that year, there will be no long term, but there will be a current liability of 199. In the 5th year, of course, we are carrying down nothing, so there will be no long term, no current. That's how that instrument will affect the balance sheet. Are you there now? I hope you have understood. So that's how we shall be determining the amortized cost using this amortization table. And once we get it, use the if finance cost to take it to the income statement of the P&L, and use the balances carried down to represent the amortized cost of the bond, which will go to the balance sheet. I've said, when it comes to liabilities, it can either be long-term or current, depending on how many more years you still have to go for you to repay that bond. Okay? Good. Now, okay. So we can now continue. Okay, what I want to do now, listen, because of the new students, I want to put down an information now. We shall continue from here next time. Next time, I'll do an illustration now from your past papers or from a question. I'll now do a complete question. I was just illustrating. The figures I was assuming 10%, 5, whatever, 12%, those were not correct actual, but we shall use the actual figures now from our question. That's what we shall do next time. But now let me talk to the new students. Let me talk to the new students now who are in this group doing financial reporting. Those who are in this group now doing financial reporting. Now listen. Now, if you as a student, you are interested in continuing with our class, then we normally have financial reporting in the evening classes, and our classes normally starts from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday. You are here and you wish to join us for the normal classes or the financial reporting of the intermediate, then the classes are from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday. Now, our system is such that, listen, in case you miss a class, let us assume on a Friday you are working late. Does it mean that you will miss that class? The answer is no. you can go back to the group where the link was posted. You click on the link and you can watch the video of the class that you missed. Or maybe I taught you something and you feel you want to remind yourself. Go back to the group, click on the video that you are taught, and you watch it as many times as you want. So that's a good thing about our system. Okay? So if you are interested, you can call me on 0722 65 8875. Listen, you may decide that you don't want to attend the online classes, but you want what we call the pre-recorded videos. Pre-recorded videos. They are still available for the whole syllabus. You can buy them at once, then you listen to them at your own pace, at your own free time. No problem. If you want to buy pre-recorded videos, they are available. Whether for pre-recorded, whether for the normal class, we are currently charging 4,000 shillings. We are currently charging 4,000 shillings. And we also allow payments in installments. We also allow payments in installments. Now listen. You may also have friends who are doing the advanced financial reporting of the advanced level. For them, you may tell them, we have normally early morning classes and we have evening classes. Our early morning starts from 5:30 a.m. to 7 a.m. 3 days in a week. And our evening starts from 8 p.m. to 10 p.m. again, 3 times in a week. Again, for them, tell them that even if they miss the class, they can still watch their video at their own free time. Okay? Them also, they can also buy what we are calling pre-recorded videos. They can also buy what we call pre-recorded videos. You may also have friends, listen, you may also have friends who are doing financial accounting of the foundation level or the one of ATD1 and ATD2. If you are friends of that category, tell them we are also teaching financial accounting. Good. I don't think I've left out anything else. The other thing I may ask you to do is please subscribe again. Let me remind you, please subscribe to my YouTube channel so that you can watch the video in case. Subscribe and click that notification bell so that you will be notified whenever we post new videos into the YouTube. Okay? Well, my YouTube channel is called CPA Joseph Njuguna. That's the name of my YouTube channel, CPA Joseph Njuguna. But even from the page you are watching now, if you have not subscribed, just click down there and subscribe. Otherwise, if you want to follow me later, you go to the YouTube channel called CPA Joseph Njuguna. Otherwise, for the normal students who have already joined, let's meet on Thursday. Let's meet on Thursday, where I now do the normal illustration. I was just using some imaginary figures. So I'll do an illustration question. Then we shall develop the topic further. We are not through yet. We are going to continue with it next time. I hope everything is okay now. So for those who are new and you want to join FR, those are the days, Monday, Tuesday, Thursday, and Friday. I've told you in case you miss a class, you can still watch your video at your own free time. In case you want to talk to me, call me on 0722 65 8875. Call me anytime, even after this, if you are free. Good. I've talked about pre-recorded videos also, where you can buy your pre-recorded videos. You watch them at your own free time, at your own pace. I've talked about advanced financial reporting for those who have students or friends who are doing advanced level. I'm also teaching advanced financial reporting. We have either early morning classes or evening classes. Early morning starts from 5:30 to 7. Normally it's Monday, Wednesday, and Saturday and Friday for early morning. Then evening starts from 8 p.m. to 10 p.m. Then I've talked about financial accounting, or the foundation level, or what used to be called section 1. Okay? Good. Otherwise, good night for now. Good night for now, everyone. I hope the new students have managed to get something. Anyone who was new here and he wants to put a comment. Anyone who is new here. Finance cost. Somebody is saying I explained finance cost. Finance cost is the same as interest charge. Finance cost is the same as interest charge. That's what we are saying. I think it's Mwendo who is saying explain finance cost. And I'm saying finance cost is simply interest. Instead of having finance cost, you can have a column called interest charge. No problem. I hope, Mwendo, you are okay now. Good. Oh, Salome, you are doing advanced. Karibu. So you can join us for advanced financial reporting. It's also being taught. After this topic also is part of your syllabus. It's only that you do more. This topic is also part of your syllabus. So if you understood Salome, then don't panic. At least it will assist you in your advanced financial reporting. Still part of your syllabus. It's only that in advanced level, you do slightly more. Okay, Salome? Sawa. But if you're interested in joining, call me so that we organize whether to join early morning or evening or by pre-recorded. Anybody else who has a comment, especially for the new students who have joined us for the first time today? I hope you have understood. Okay. So see you then next time. See you next time. Bye for now. See you next time. Bye, unless there's another comment. Okay, see you too. Good night. Sawa. Good night.